Hello and welcome to this video on our external methods of finance. In this video, we're going to go through a variety of different methods and go through their advantages and through their disadvantages. And these methods will include our loans and share capital. We'll also take a look at our venture capital and our overdrafts. Then we'll take a look at our leasing, our trade credit, and to finish up, we'll take a look at grants. Let's get into it. The first method though that we're going to be taking a look into will be our loans. Now let's give you all a definition because I know you all love your definitions. Now what we mean by a loan is that this is a borrowed sum of money that businesses must repay over time. So it's a debt method of finance. And typically we'll have to pay some interest. Of course, this does depend on those agreed terms. Now, you will normally get your loans from banks, but it can be through a variety of different methods as well, such as family and friends. And when you take out that loan, you will have to sign this loan agreement, and this will outline a variety of different things. For example, it will outline your repayment schedules, so how much you need to pay and in what dates. It will also agree the interest rate, whether this is fixed or variable. And don't worry, we are going to go through in just a moment what we mean by interest rates. Of course, it's going to show you the loan amount, any penalties for late payments, and any collateral required. Now you might be asking, Jack, what do you mean by collateral? So let's say for whatever reason, you can't pay back off this loan. So you took out £100,000 and you can't pay back. Collateral refers to an asset that you own, which is pledged by the business as security for the loan. So if I happen to have a building worth £100,000, so if I can't pay back that loan in cash, the bank or whoever's giving me that loan will be able to claim and seize that asset instead. Now, we said earlier, when a business pays back a loan, typically they'll have to pay back some interest. And what we mean by interest is that this is the cost of borrowing money or the rewards for saving, so as a dual purpose. But from a loans perspective, we're looking more so at the cost of borrowing. So let me show you this example here. Let's say I go to the bank and I ask for a £10 million loan and they say, yes, no worries at all, we'll attach a 6% interest rate. So I get that £10 million, however, I have to pay them back £10,600,000. So that additional £600,000 that I have to pay back, that is classed as our interest. And the interest rates that your bank will set, which is normally a commercial bank, is going to be heavily influenced by what the Bank of England's interest rates are. The Bank of England is like a bank for banks. So when the commercial banks need to borrow money, they go to the Bank of England to do so. And the Bank of England, they change their interest rate depending on what the level of inflation is. And what's also important to know is that your smaller businesses, we know they are perceived as a higher risk because they've got a higher likelihood of failure. So when you have a smaller business looking for a loan, they tend to have to pay higher interest rates. But your larger businesses, they've got greater negotiation power because banks can earn a lot more money because they're offering them a larger loan. So as a result, interest rates tend to be lower for your larger businesses because they get the benefit of financial economies of scale. So what are the advantages and the disadvantages then of using loans as a source of finance? Well, it's a good thing because you've got these fixed repayments after you've signed that loan agreement. So you know how much cash is now going to go out the business at what specific time. So it's great for when you are trying to plan that cash flow. As well, this is a debt source of finance. We are just borrowing the money. We are not giving away any ownership. So we are able to retain full control. It can also give the business a large amount of finance. For example, in 2022, Nike secured a $1 billion unsecured revolving credit facility from a Bank of America. This 364-day loan was established to provide flexibility for general corporate purposes, for example, including the support of the issuance of commercial paper. And as we said, if you are a larger business, you have a bit more negotiation power to get a lower interest rate, so it doesn't cost you as much. However, of course, there are several drawbacks that we need to know. Those interests, remember, it's the cost of borrowing, so it will be recorded as a cost for the business. So when you take out a bank loan, the interest increases your cost and your profit and your profit margins begin to reduce. The repayments as well must be made regardless of how well you're doing as a company, whether there's a recession happening or whether the economy's in a boom. So whether you're making enough money to pay it back, you still got to pay them. And like we said earlier, you may need to sign up some collateral, which puts some risk of you losing some of your business assets, of course, if you can't pay the loan back. And not all businesses will qualify for the loan. Some banks may see the business as too risky. And the overall process to try and get the loan, because remember, you're going to have to make a business plan, you're going to have to make a case, you're going to then have to wait for the approval. This can be quite a long time until you get the loan. And of course, it's not guaranteed. The next method of finance that we're going to take a look into now is our share capital. Now, what do we mean by share capital? Well, it's in the name. Try and break it down. Shares, we know a share in a business represents ownership, and capital is just another way of saying money. So when we put that together, share capital is the money a company raises by issuing shares, and issuing just means selling, to investors in exchange for ownership in the business. Now, the only type of business forms can raise share capital is your private limited companies and your public limited companies, because remember, they are made up by shares. Your sole traders and your partnerships, they are unincorporated business forms, so the owner and the business is treated as the same legal entity. However, what you'll find is that your public limited companies tend to have access to larger amounts of share capital than your private limited companies. Because if you're a private limited company, you can only sell your shares privately. But if you're a public limited company, you can sell your shares on the public stock exchange. And when we look at the type of finance this is an equity source of finance, which means you don't need to repay that money back like you would if it was a debt source of finance. But of course, you're giving away ownership of your business. Keep that in mind for our disadvantages. But let me show you how an example would work. Let's say I've gone to an investor and said, I'm going to sell you 100,000 shares in my business. That could represent, 5% of the total company. And they give me £1 million. That £1 million that they're investing into the company, that is what's classed as share capital. So you might be asking the question, well, why would someone want to buy shares in a business if they're not repaying them that money? Well, they do make money in a variety of different ways. There's two key ways that a shareholder can make money. The first way is through dividends. Now, a dividend is a share of the company's profit. The second way is through our capital gains. Now, I might buy a share in 2020, which is worth £50. But in 2025, the share price has gone up and it's now worth £100. So I've made a £50 profit if I decide to sell my share. And as well, your shareholders do get the right to vote, so they can influence decision making. And a great question that a business would want to ask is, well, which is better for the company? Paying back borrowed money or paying dividends because we've sold shares of our company? I've got this comparison here. Well, if you borrow money, it's good because the length of the payment, you know that as soon as you paid off that money, it's done. You don't have to keep repaying it. However, with dividends, you would have to keep paying them as long as they own those shares. And in terms of the impact of your profit, we know when you borrow money, typically you have to pay back some interest. That interest is a cost of borrowing, so that tends to reduce your profit. Whereas dividends, it doesn't necessarily impact your profit, but it could impact the amount of retained profit you keep into the business. In terms of the timing, typically you have regular and scheduled repayments that you have to make. But whereas a dividend, you only have to pay them if the company makes profit and if everyone votes that you should be paying it. And in terms of the impact and ownership, of course, if you borrow money, you're not giving away shares. But if you look at share capital, you are giving ownership away. So you're diluting the ownership amongst those existing shareholders. So what are now the advantages and the disadvantages of share capital as a source of finance? As we said, we are not borrowing money, therefore we do not need to repay them. We don't need to repay them the amount that they've invested. Of course, they will make money though in other ways. No interest is needed to be paid. Once again, we're not borrowing the money, so our costs don't increase as a result of share capital. It's a great source of finance as well for your public limited companies. Private limited companies, yes, it's also extremely valuable, but especially for those public limited companies because they are operating on the public stock exchange. Can also invite some new investors into the business. So we could be a private limited company and some investor wants to invest in our business. They could provide their own perspective, their contacts and different ways for us to grow as a company because they want the business to do well as they now have ownership into it. However, of course, there are several drawbacks that we need to look into. The biggest one, it is an equity source of finance, which means we are giving away part ownership. So for those existing shareholders, they're having to dilute their ownership. Their vote now isn't worth as much. And as well, over that long term, the amount of money that you're paying in terms of dividends to these shareholders could actually be a lot higher than you would pay on the interest and the amount that you've borrowed in terms of a loan. And as well, if more people want dividends, of course, this reduces the amount of retained profits that you've got left to reinvest back into the business. Just a quick one, if you are looking for a little bit more help with your business studies, whether that's building more confidence with the content such as the calculations, the theories and models, the key terms, or whether it's getting a bit more clarity on the correct exam techniques that you should be following, or even if it's getting more personalised feedback on the exam answers that you have been writing, well, I've got a tutoring program which is taking on a limited number of students who are looking to really improve their grades in business. And we offer a variety of different services for our students, whether that's one-to-one sessions, small group sessions, online courses, online resources, message support, personalised feedback for exam marking, and so much more. As I said, we only have a limited amount of spaces, but if you are interested, check out some of the links below in the description. Back to the video. Our next method of finance that we're going to be taking a look into now will be our venture capital. And in terms of defining what we mean by venture capital, this is a form of private equity financing where investors provide funds to startups or small businesses with high growth potential in exchange for ownership. So you'll find that venture capitalists will tend to invest into these smaller businesses with more high growth potential. Of course, they've got to be a private limited company because they need to have shares to sell. You won't find venture capitalists investing in public limited companies because the key thing about venture capitalists is that they've accumulated their wealth from either being CEOs, high up in businesses, or setting up their own businesses in the past. So what we know about venture capitalists is that they're extremely knowledgeable. So they provide a lot of insight and guidance to these small startup business owners. But as we said, they only want to invest in businesses where there's a high growth potential. Some great shows to watch, Dragon's Den and Shark Tank, which is the American version of Dragon's Den. So in terms of the advantages and the disadvantages then of using venture capital as a source of finance, first of all, we have access to funding for these smaller businesses. And the great thing about venture capitalists is that they understand that your smaller companies, there's a lot more risk involved. So your banks may be more reluctant to give the loan to these, but a venture capitalist is a lot more willing to help and invest in these smaller companies. And as we said, if you're a small business, you potentially lack the experience. You're not sure how to market, how to grow a team, but you're going to be working with individuals who have done this for years and years. So they can provide you with guidance, they can provide you with mentorship. And not only that, they can also give you access to their networks. They may have amazing contacts of suppliers, of marketers, of key influences in the industry that could help grow your company. And if you are seen to have investment from one of these famous venture capitalist firms, your business all of a sudden becomes a lot more reputable because they are being backed by highly credible individuals. And as we said, this is an equity source of finance. You're not borrowing the money, so you do not need to give that money back. Of course, you are given ownership, which is the big problem when it comes to our venture capital. You are losing control. They may take anywhere between 10 to 50% of your company. So they're going to have a bigger involvement now in the decision making. And of course, that can slow the growth of the company down. The venture capitalists as well, they want to invest in companies with high growth potential because they want to make a lot of money. So they might be putting a lot of pressure on you now to get high returns. And once again, it can be quite a time-consuming process to secure this funding. You obviously have to submit your business application, that then gets accepted, then you pitch in front of them, and they may not even go with your company. It's also not suitable for businesses without that high growth potential. So for example, if you're a private limited company and you're a family-owned business, venture capital may not be the best route for you. And finally, as we said a bit earlier on, they are trying to prioritize financial returns. The next finance method that we're going to be taking a look into now is our bank overdrafts. Now, what on earth do we mean by a bank overdraft? Well, this is a short-term borrowing facility. The reason why it's short-term is because of the higher interest rates, but more on that in just a moment. That allows a business to withdraw more money from its bank account than it currently holds up to an agreed amount. And as we said, your bank overdrafts will have a lot higher interest rates than your loans. So for example, a bank overdraft can have an interest rate of anywhere between 20 to 40% per year. But when we look at a bank loan, it's typically in the regions of 4 to 8% per year. And this is why it's a short-term borrowing facility, because you don't want to be in your overdraft for too long, otherwise those costs are going to start increasing. So to show you an example of how this would work, let's say this is my bank account for my business and my balance is currently minus £2,436.21. The reason why I can go into the negatives is because I went to my bank provider and I asked them to set up an overdraft limit. My overdraft limit could be £5,000 to £10,000. The way our interest is calculated, it's done on this daily basis on the amount of the overdraft that is used. So the daily interest for this type of bank overdraft would be around £1.67. So what I've done is I've applied a 25% annual rate. So the daily interest 0.25 divided by 365. And then I take that value times by £2,436.21. So it's approximately £1.67. So what are the advantages? What are the disadvantages then of using our bank overdraft? Well, it's brilliant to solve these short-term problems. Now, when I think about these short-term problems, I think paying our staff, paying our suppliers on time, because it's a quick access to cash if I've already got the overdraft set up. And of course, interest is only charged when I'm in my overdraft. So of course, if I don't have an overdraft or I'm not into it, I don't have to pay any interest. And as the business begins to grow over time, the overdraft limit can also increase to keep up with our growth. However, the big problem is the interest rates. They are extremely high, especially compared to other borrowing methods, which is why, once again, this is a short-term borrowing facility. The bank as well can turn around to you and say, we need to have this money back right now or within the next few days, so you need to come up with that cash in some different way. And as well, how much money you can go into your overdraft? Well, it depends on that agreement, because your bank may say, oh, we're only going to give you a £5,000 overdraft. But what if you needed to go to 10? How would you negotiate that? And potentially they may just completely reject you altogether. The next method of financing that we're going to take a look into now will be our leasing methods. Now, what on earth do we mean by leasing? Well, leasing is a finance method where a business rents an asset instead of buying it outright and making these regular payments to use it. So this saves the business paying a large upfront fee, which is good for you in the short term. But over the long term, you end up paying more money and you don't own the asset. More on that in just a moment. And in terms of the typical assets that you would want to lease out, well, this could be like vehicles, so like a company car, a delivery vehicle. It could be an IT equipment such as computers or large industrial machinery and equipment. Now, let me show you a cash flow example when comparing to if we was to purchase the asset outright versus leasing it. So you can see in year one, if we was to purchase it, that's £20,000 down the drain. But in year one, if we was to lease that asset, we're only spending £5,000. But of course, for year 2, year 3, year 4, year 5, you're not spending any more money if you've already purchased it. Of course, you might need to do your maintenance and your upkeep of it. But if you're leasing it, you still have to pay £5,000 every year. So after those 5 years, if you purchase the asset, you've only spent £20,000. But if you've leased it, you've now had to spend £25,000 and you might not own the asset at the end of it. So what are the advantages and the disadvantages then of using leasing as a source of finance? Well, it's brilliant because you don't have to pay that large upfront cost. Now that can really support your cash flow in the short term because instead of doing that one large upfront payment, you're now spreading this over a period of time. And you can now have access to the latest and the best technology and equipment without having to pay, once again, that large upfront payment. And with the leasing agreement, typically they will obviously conduct the maintenance and the repairs that are needed. However, of course, there are key drawbacks that we need to consider. Leasing tends to be a lot more expensive over time. So you saw from that example there, we've got more cash flowing out of the business over the long term. And as we said, the business, you don't get to own the asset if you're leasing it because you're just borrowing that piece of equipment or that vehicle. So if you don't own it, you can't then resell it at the end of that use in order to gain a little bit more cash. It can also be very expensive if you need to cancel that leasing agreement a bit early. Typically, there may be a £5,000 to £10,000 charge to get out of that agreement. And as well, you may have some restrictions in terms of how that asset is used. So for example, if we're looking at a delivery van, you can't potentially put your branding all over the van. But of course, if you owned and you purchased it, you can do what you want with it. The next method of finance that we're going to be taking a look into now will be our trade credit. Now, the way trade credit works, essentially we go to our creditors, typically our suppliers. Now, of course, they're going to sell us our raw materials that we need to make for our products and services. Now, what a trade credit period allows me to do, I get those raw materials today, but I don't pay them until 30 to 90 days in the future. And the reason why we want to do that is because I take those raw materials, I use it to make my product, I sell my product, and that helps me get the cash. Now, just a quick example of how this would work. Let's say I go to my supplier and I say I need £100,000 worth of raw materials. So they ship it over to me and I say to them, I'll pay you £25,000 cash today, but give me around 30 to 90 days time and I'll give you the rest of that £75,000. How this works, there's three key things that we need to look at in our financial statements. What's our cost of sales? What's the cash that we recorded? And what's our trade payables? Well, the cost of sales, even though you've not paid them the entire amount today, you still have to record it in a full amount. So your cost of sales would still be £100,000. Now with cash, you just record the flow of money. Of course, we've only spent £25,000 today. And our trade payables, which is essentially the amount of money that we now owe to those creditors and suppliers, would be equal to £75,000. So what are now the advantages and the disadvantages then of using trade credit as a source of finance? Now, this is brilliant to help improve our short-term cash flow position because it just gives the business enough time to make those products and sell those products to have money coming into the business. And it helps us manage those trade receivables and those trade payable days. So the trade payable days is how long it takes for you to pay your suppliers. Your trade receivable days is how long it takes for your customers to pay you. Now, ideally, you want your trade receivable days to be lower than your trade payable days. So you're getting money quicker in the business than it's going out. And it allows time, once again, as we said, for the business to sell our goods before paying our suppliers. However, there are several drawbacks that we need to know. It can damage our relationships with our suppliers because if we keep saying to them, let me pay at a further later date, well, they've got to think of their own cash flow and their own problems and their own expenses to pay. So the more we delay it, then the worse that relationship can become. And not all suppliers will be willing to offer the trade credit. Now, this depends on the bargaining power of suppliers. Now, if you have this one large supplier who you rely on and there's no one else out there, there's not much chance that you can really negotiate favourable terms in this agreement. But if you are a massive business and that supplier now relies on you, you've got a bit more bargaining power over them. So as we said, whether you can negotiate favourable terms or not depends on the bargaining power of suppliers. And the very last method of finance that we need to take a look at now will be our grants. Now, what are grants? What's this all about? Well, grants are non-repayable funds to support businesses, often for our specific projects, for innovation, or through growth. Now, it can be given by government or these private organisations. So typically, you need to apply for these competitions and do business pitches where you'll talk about your business and why you deserve that funding. There may be some set criteria that you need to meet in order to actually go into those competitions. So for example, you've got young entrepreneurs, you've got businesses that solve social objectives. The government in the UK have just announced some more initiatives to help fund these AI startup companies. So what are the advantages and what are the disadvantages of using grants as a source of finance? Now, as we said, it's a non-repayable fund. So I don't need to pay that money back. It's cash coming into the business without any outflows having to go out. And as well, this isn't a debt source of finance. We're not borrowing that money, so there's no interest paid. We're not increasing our costs, so it doesn't impact our profit margins. It also supports businesses who have these innovative initiatives. So if you're a small startup company, you've got a brilliant idea, but it's going to cost you a lot of money through research and development and hiring a team, well, grants could be a brilliant way to help get that funding. But of course, that's if you have an innovative idea. And finally, it can also help improve your business's reputation and credibility. Because if you're announced the winner of a Young Entrepreneurs Award, for example, and you had that funding, best believe that's going to be all over social media. And if you're known to be one of the best young entrepreneurs, more people then start to believe in your product and your story. However, of course, there are some drawbacks that we need to know. Firstly, these grant competitions, they're very, very competitive. You may have tens, if not hundreds of thousands of different businesses trying to compete to get that fund. It can be quite time consuming as well within that application process. You're going to make a business plan, you're going to make a business case, and as well, you might do all of this and still not get accepted for the grant. And as well, it depends on the type of funds that you're going for, but it can be quite strict in terms of what you can spend the money on. You need to submit within your business case to this grant, I'm going to spend the money on X, Y, and Z. They may turn around and say, no, we don't want to invest it on the Z, but the X and Y, go for it. If you found this video helpful as part of your finance revision, then I highly recommend you check out our video here on our cash flow forecasts. I hope this video has helped you with those external methods of finance. Thank you so much for watching, and I'll see you in the next one.